Welcome to the Demystifying Technology podcast from the MacLaurin Group.
Typically, you go through the due diligence process. What the world of private equity.
Right. Can't wait. Demystify it. Welcome to the Demystifying Technology podcast from the MacLaurin Group.
Typically, you go through the due diligence process. What the world of private equity.
Right. Can't wait. Demystify it.
MacLaurin Group was a proud gold sponsor of this year's ACG Richmond Capital Conference. While there, we hosted a series of short conversations with experts in the private equity space to discover their outlook and areas of excitement as they look toward the coming year. We are joined by Gretchen Perkins of Huron Capital as she discusses with Alan Williamson investment strategies for both the traditional buyout versus non-control equity. Gretchen goes deeper into how their flex equity fund helps business owners who have no intention of selling increase capital without debt. This is especially helpful for business owners seeking add-on acquisitions to accelerate growth and achieve their preferred valuation.
And welcome back. We're here at ACG Richmond, Virginia. No, it's not September, it's October. Started off wrong already. But we've got Gretchen Perkins here from Huron Capital. Gretchen, thank you for taking the time with us.
Well, thanks very much for the invitation.
So, tell us about Huron Capital. What are you all about?
Huron Capital is a lower middle market private equity fund. We are proud to be celebrating our 20th anniversary this year. We like to focus on investing in businesses that range in revenue size from 20 to 200 million and EBITDA from $4 million and above for the platform company. We also have a buy and build strategy we employ, which means after we buy and invest in the platform company, we do multiple add-on acquisitions. And those can be any size. They do not have to meet the minimums that I stated. Our sectors of interest are consumer products and services, business services, and specialized industrials businesses, meaning companies that are providing products or services in an industrial environment.
Good. And the firms that you're investing in, is this typically their first time in the private equity cycle, or are you second, third generation?
Yes. No, very typically, over 90% of the time, our businesses are founder-owned, and they are looking for a partner to help them create a liquidity event so they can lock away some of the wealth that they've created over their years and years of blood, sweat, and tears in their business. But also, many times it's a partner for growth, where they want to grow, they need some additional capital and resources and expertise to help them take it to the next level.
So you're preferring for the founder to stay on and go through the next cycle with you?
Yes, we are management team first. Most important thing to us when we are assessing different investment opportunities is the team. So the founder and the team that he or she has built around them to work with us and help carry a business forward.
Great. So you were talking to me before there about the Flex Equity Fund. Talk to me about that.
We have two strategies at Huron Capital. One is a traditional buyout strategy, and we are on our fifth fund for that. We also have another strategy, which is a non-control equity strategy. So we have raised a fund, which we call the Flex Equity Fund, specifically to invest with business owners who need a slug of capital that is not debt, that can help them accomplish a number of goals. But this is for the business owner who has no intention of selling his or her business. They simply need some capital.
But you're not taking a controlling interest at that point. You're
Correct.
Purely
we are under 50% ownership.
And how well is that fund going?
The fund is going very well. We are invested in a number of businesses for different purposes. In one instance, the business owner was looking to sock away some liquidity and find a partner for growth. In one business, specifically, business owners were looking for someone who could help them accomplish add-on acquisitions to accelerate their growth. You know, there's numerous businesses out there that may have gone to market for sale and they realize they're not getting the number that they have in their head. Our Flex Equity Fund is a great solution to partner with them, to provide them the capital where they can make a couple of add-on acquisitions and get to that EBITDA number they need to be at to accomplish the valuation that they are seeking. Our Flex Equity Fund also, we are indifferent if the money stays in the company, say for making some capital equipment expenditures, making some add-on acquisitions, investing in sales and marketing, or if the money goes out of the firm, unlike debt. If you take debt capital, they're going to want you to keep that money in the business and not dividend anything out. With our Flex Equity Fund, it's fine to dividend out the capital somewhere else to accomplish a liquidity event, to buy out a shareholder, etc.
And is there any sort of long-term plans to turn that part investment into a full-term investment? Are you the next logical partner to talk to regarding a full buyout?
No, that's actually not our intention at all. That fund is not to be considered a feeder fund for our flagship buyout.
So they can be rest assured that this is purely for...
Rest assured, we have a 5-year put that we negotiate at the beginning. So everyone, all parties know that in 5 years, we're going to have the right, not the obligation, to put our ownership back to you as the business owner. And at that time, you can decide whether now it's time to exit or you can source other capital to replace us. Yeah, we're specifically not intending to exit that fund into our flagship fund. And the reason we have the 5-year put is we have our investors are typical private equity fund investors. They're pension funds, foundations, nonprofits, college endowments. They need their money back so that they can make scholarships to students and pay pensioners and etc.
So you talk about growth there a number of times, how about the companies are usually needing the capital to grow growth. How do you help them with that growth outside of just writing a check?
Well, our capital is the ultimate commodity, right? It's currency. But a business owner is going to partner with Huron Capital if they're interested in much more than just the dollars. We intend to be a valued partner. We bring a slew of resources to business owners to help them grow. Every private equity fund has the same mandate: generate good returns for our investors, pension funds, college endowments, foundations. To generate the type of returns they expect from our asset class, we have to accomplish growth.
Yes.
We must accomplish growth. So what Huron is going to bring to the table is our host of operating resources. We have operating partners on staff, on salary, partner level folks at Huron Capital to help. We also have a roster. If you look on our website, you'll see 50 or so other operating partners that are not on salary at Huron, but they are our bench. We bring them in as utility players as their experience and expertise is relevant to portfolio by portfolio company basis. And these operating partners, the ones not on staff and the ones on staff, are absolutely critical to helping us achieve growth, and they are transformational additions to boards and such.
So you definitely encourage your portfolios to pick up the phone and seek for the help.
Absolutely.
From you, from the first of all, and you can put them. So let's go back a little bit with respect to, you must see an awful lot of pitch books and decks, etc., as you're going through and trying to evaluate this. Well, what are you starting to see a lot of, and what sort of mistakes are you seeing, and what piques your interest?
Oh, mistakes I'm seeing. I would really wish the investment banking industry would stop saying every product or every service is mission critical, because they're not. They might have a great defensible niche, but they're not mission critical. That's getting to be a joke, frankly, in the industry. But more seriously, I think the mistakes that I see consistently in teasers and in CIMs are mistakes of omission. There are certain hot buttons right now that, most investors are going to ask about. Tariffs are a big question number one. How is this business impacted by tariffs? Show us that in the CIM. How did they do were they in existence at the last downturn? And if so, how did they do? We're always going to want to know that. As we're sitting in year 11 of the current economic expansion, anything we invest in today, there will be a downturn on our watch. I don't know when it's going to be, but it'll be sometime in the next 5 to 7 years. So we're all going to want to know that. Customer concentration, please spell it out clearly. We're always going to want to know that.
Brilliant. So when you look at your sort of founder, what is the characteristics, the personality of that founder that you're looking for that's going to be part of the Huron family?
For the underlying portfolio company?
Yes.
Yes. What we're looking for is a business, as we say at Huron, that's clicking along just fine, but it's not clicking on all cylinders. We want a solid business that has a defensible product or service, margins that convey that it's not a commodity product or service, and to us that benchmark is 10% EBITDA margins. Businesses we invest in need to have 10% EBITDA margins or above. We want to see a fragmented industry, so there are multiple opportunities for add-on acquisition so we can implement our buy and build strategy. We want to see a strong management team. It all begins with management. We want to see a strong CEO with vision and good leadership skills, and as part of leadership, an ability to have a next gen of promising people coming up. That's another one of the resources we bring to this business owner. We can help widen the pool of candidates for growth. We can help position and professionalize your finance function for growth, because we're going to be doing add-on acquisitions. We generally need to upgrade the CFO, the finance position. Many times they don't have a CFO, and we need a CFO in there. Not displacing or replacing the controller or the bookkeeper, but augmenting them. We are looking for folks who are coachable. We're looking for folks who are interested in our input and our expertise. And, there's lots of businesses we look at and we decide, this management team is not self-aware enough to be able to accept coaching. And we want to make a difference. We want to help. We want to augment the business. We want to accelerate growth. We want to expand their markets and their services. And they have to be interested in accept that assistance, because that's what we do. We've done over 180 deals over our 20-year history. We have a track record of pressing the various levers to jumpstart growth. That's why we're investing in a business. So we want someone who's interested in that. There's usually a couple of camps. There's a business owner who is very fired up about that. And the thought of having, someone else to bounce ideas off of, and a crew of people who are very, very invested in seeing his or her business succeed. We're a great partner in that regard.
And with respect to, so you clearly know what you're looking for when you see that isn't there. Do you see people that want to exit but have got their second in command that they want to sort of elevate up, that you
Sure.
maybe need to coach a little bit more?
Absolutely. That happens very routinely, where a business owner will roll over a portion of the equity proceeds that they get. Maybe they'll roll over 15, 20% into the new deal, but they fully intend to step out of the president or CEO role and they want to be more of a chairman. Absolutely. And it's really gratifying to be able to invest in a business and allow for equity participation down through the management team and help generate wealth for the next crop, the next generation.
So as we look at the sort of the end of an investment side of the fence, outside of making some money for your investors, what is the successful sort of, that's a proud child of the Huron Capital family that we've exited from?
Well, I frankly just mentioned what is another thing that shows it's a good exit, where we've created returns for our investors, obviously, very important, but we've created some wealth in the company's employees. And that's very gratifying, where the investment has gone very well and cooperatively, and we have a great blueprint and a great advocate referral source of the management team and the former CEO, former owner. So the next 5 deals we are pitching a new management team, we can say with extreme confidence, call any one of these 10 people at this company where we just did what we described we plan to do with you, and you can check us and see how Huron performed. So that's a very good exit. I don't want to give short shrift to the investment returns. Not obviously, we all want to make strong investment returns. But again, I think what gets lost in a lot of the media coverage of the private equity industry is the ultimate beneficiaries of our investments and our exits when we have a great and very profitable return. And that's people who collect a pension. That's college kids who get to go to a university that they wouldn't have been able to go without the university providing them a scholarship. It's a nonprofit foundation who invests in the private equity industry to be able to generate great returns so that funds their mission of research or art or literacy or whatever. And who collects pensions these days? You know, it's really probably
Mm-hmm.
not anybody here in this room. It is policemen, firemen, teachers, municipal workers, factory workers. Those are the folks who are the ultimate beneficiaries of the private equity industry. And I take any opportunity at any microphone to remind everyone of that, because I'm tired of my industry getting bashed.
Well, speaking of that, Gretchen, as we round up here, what as a sort of the new founder, CEO that's looking to go into the private equity space, what is the one myth you would like to dispel from them, that they're maybe a little bit cautious?
That we're scary and we want to buy them and sell their assets and fire their people. I mean, that's the right? That's the common fraudulent tagline. That is not what we do.
We call that the Richard Gere Pretty Woman
Exactly.
moments, yes.
I'm not kidding. That movie has done decades of damage to our industry, because that's really what people think. And I mean, if you just think about it, the arithmetic of that, you cannot achieve returns that are required in this private equity industry for our investors if you don't have growth. I happen to be co-chair of the ACG's Public Policy Committee, and we have a resource that we contract, and it's called growtheconomy.org. I would encourage everyone who's listening to this to take a gander at that. You can slice and dice all 400 plus congressional districts in the United States. You can look at it by state. You can look at it by the nation. And the data show overwhelmingly businesses that are backed by private equity and private capital generate more jobs and more revenues than any other form of business ownership, whether it's founder-owned or publicly owned. And that is a fact. You can't argue with the facts. The facts dispel that we break companies down.
And we've also got to remember that Julia Roberts turned Richard Gere around in the end and asked him to invest to grow
Indeed.
the old man's company. I mean, there was a happy ending story there.
There was a lovely ending. No one remembers
But we
that.
forget about that part.
No one remembers
yeah.
that.
We remember the
They
big
only-
mistakes scene.
They remember
but-
greed is good.
Great. Gretchen, thank you very much for taking the time out to speak with us today.
Thanks for letting me chat as well.
Thank you.